Okay, let's say you have this little girl. She's 10 years old and she wants to open her own lemonade stand. Her parents say, okay, that sounds good. So they go to like a flea market and buy a $200 stand. Then they stop by the grocery store and pick up $100 worth of ingredients, ice cups, etc. And the parents give their daughter all of this stuff and say, it's yours, you can have it, you don't owe us anything. So what the girl does is she takes out a notebook and titles the notebook My Lemonade Business. So, the only things she's going to write in this notebook are directly associated with the business. And she has an accounting equation written out, and she puts that she has received a stand worth $200, and she has also received $100 worth of ingredients. Okay, and remember, when you're putting an entry into the accounting equation, this entry is always going to come in pairs. So in a way, you're going to want to put in what has kind of come into the equation or left the equation, and then your second entry would be accounting for why that happened or where that came from. So the girl received these assets. Now she wants to make another entry that's reporting where they came from. Okay, so did her parents say that she needs to pay them back at some point for all of this? No. So no liability was created. What happened was the girl put in some of her own personal things that she owns into the business to run the business. So all these assets are going to be associated with common stock, to where she's going to create an account with her name in the title, a common stock account with her name, a sub account. She wants to make a sub account because, common stock can come from different entities, right? So let's say her name is Casey. She wants to record that on this date, she put in personally $300 worth of assets, which is shown here. Okay, so now you're driving down the road and you see this lemonade stand and you decide to stop and get a drink. The girl tells you that she's not open yet because she really feels that she'll need more lemonade before she opens to meet the demand that she plans to see at the location that she's at on a hot summer afternoon. So let's say she's set up in a park or something, a busy park, and she's afraid of she's going to end up having a big line and all of a sudden running out of product, and customers will get angry, and this could really hurt her brand. So what she asks you is if you would like to invest $75 into her business, and in exchange she'll give you a 25% ownership share. And she even has this contract written up, and 25% in exchange for $75 makes sense here, because $75 is 25% of all of the assets that she currently has, all of her net worth, right? I mean, she's not worth that much money. At least her business is not worth much. So you give her $75, that's a good chunk of everything she has. So she says, I'll give you 25% of my business. So, you laugh like, what is this for real? Is this kid serious? But you think it's cute, so you write her a check and sign the contract. And before you leave, the girl even takes a picture of you, prints it out, and pastes the picture next to your signature. And she asks you to initial there as verification that is in fact your signature. So the girl then cashes your check and puts the cash in a locked drawer that came with the stand. And she opens her notebook again to record what just happened. So she reports that her business has received a cash asset, $75 in cash. Okay, and now she also wants to record the second entry of where this cash came from. Did she promise to pay you back at some point for the cash? No. This money couldn't have come from retained earnings, because retained earnings is associated with running the business. It's revenues and expenses and dividends. Well, she hasn't even opened the stand yet, so this can't be retained earnings. So this $75 is related to common stock, but not common stock that she personally contributed. She's going to create another common stock account with your name in the title that has a balance of $75. Okay, so, you can see, and this kind of shows you, if you looked at any business in the world's common stock, you zoomed in on that business's common stock accounts, the common stock accounts are just kind of showing you, who has contributed money into the business in exchange for ownership to date. And so who are all the owners and how is ownership distributed? Who owns what percent of the business, etc. So, okay, it's summertime. The girl is off of school. And she wakes up the next morning, takes the cash from the cash drawer, and goes to the grocery store to buy more ingredients that she needs. So she buys her ingredients and opens up her notebook and records that $75 cash has left her business. So now she has no cash. She has no cash in her possession, at her disposal to do anything. But her ingredient value, her amount of ingredients have increased by $75. So she now has $175 worth of ingredients that she needs more ingredients to open to make more lemonade. So you can see now that $75 that you gave her doesn't exist as cash anymore. It now exists as ingredients. But you wouldn't say that you only own 25% of the ingredients. You own 25% of all of the assets associated with this business. So you add up all the cash, the stands, the ingredients the girl has, you own 25% of that value. So, okay, the girl opens her stand. It's the start of summer in June, and all of June she is generating net profit after net profit after net profit. So what this means, revenues are exceeding expenses and her business is making money. All of these net profits are associated with her cash drawer. So every day, net profit, what's happening is her cash drawer is building up, getting bigger and bigger. So maybe at the end of June, her cash drawer has $500 in it. And again, where's the second entry to account for where all of this cash is coming from? Well, like we said, this is coming from net income. Net income is causing this to happen. So every day she's recording her revenues and expenses, and so it's this retained earnings account that's accounting for where this money is coming from. And again, though, because you own 25% of this business, you zoom in on common stock, that means you stake claim to 25% of all of these all the value of all these assets combined, including this $500 that she just made. All right, so now let's say maybe word is spreading about how good the lemonade is. So a lot more people are starting to come. What the girl has noticed is that at the beginning of June, there was not too many customers, but as June went on, more and more and more customers started coming. And so in anticipation for July, she has gone out and bought a few more stands, a lot more ingredients, some chairs and tables. She's hired a few more friends to help run the other stands. She spreads these stands out around the park. And so as all of this has been going on, she's been recording, she's buying all this stuff with, it must be with this cash she has. So her cash account has been shrinking maybe back down to, let's say, $50. And so $450, she spent, maybe she's bought a bundle of 3 stands for $300. So now she has $500 in stands. She's got, even more ingredients, right? She's got some chairs, tables, etc. So her cash assets that she made in retained earnings from revenues and expenses no longer exist as cash. Now that's distributed amongst equipment and stands. So why would the girl spend all of her hard-earned cash that she made during June on stands and chairs and equipment, right? She can't have any fun with any of this. Well, why doesn't she just take her money and go to the movies, buy toys, buy a bike? Well, okay, this is because she felt that due to the demand increase that she expected to see in July, if she reinvested her money and expanded her operations, she stood to make even more profit in July than she made in June. Okay, so now let's fast forward 20 years. The girl is now 30, and her business, let's say, has grown to a net worth of $100 million. The official definition of net worth says it's just that, okay, the total value of all of that business's assets minus that business's liabilities. So what net worth means is just all of the asset value that the owners of that business are in possession of, or not in possession of, or stake claim to. It's theirs. But for simplicity in analyzing the accounting equation, let's first say that over the past 20 years, the girl has never once created a liability. So what that would mean is that since we said that the net worth of the business today is $100 million, then the total value of all of the business's assets must also be $100 million, because net worth means the owners own $100 million worth of assets. So that means that the stockholders' equity, the owner's equity, there must be $100 million in this business that they own. So, okay, today there's $100 million in assets. All right. So we need to update these assets. Maybe shouldn't have a cash drawer. Maybe the business's bank account has a balance of $15 million today. All right. Her stand, it wouldn't be stand. You maybe call it, she have buildings spread out around the country. Buildings. Maybe she has $50 million in buildings, $1.2 million in ingredients. Maybe she's got some land in prime locations on busy street corners. $20 million in land. Okay, but she's paid. This is all paid for. This is all owned state. It's all owned by the owners because, like we said, there's no liabilities have been taken out. So if all of these assets, $100 million in assets, have come from or related to equity, then where has she been, what part of equity, common stock or retained earnings, where has she been recording where all of these assets are coming from? So there's two ideas. Maybe someone gave her $50 million as an investment in her company. Maybe she went on Shark Tank and, one of the sharks said, look, I'll give you $2 million, and if you give me 10% of your business, right, or something like that. But let's also say, okay, she took on no liabilities over the last 20 years. Let's say she also accepted no external contributions in exchange for common stock, and she didn't put in any personal money as well. So in the case of no liabilities and no common stock changes, net worth of $100 million, the retained earnings account must be equal to $100 million minus this little $300 investment and $75 investment 20 years ago that's, somewhere distributed amongst these assets. So for this scenario, that little $75 check you gave her 20 years ago has made you worth $25 million. You own $25 million worth of things. So, it's weird to look at this scenario and see, common stock, the balance has remained at $375 total every year. This is so small in relation to these surrounding accounts, hundreds of millions of dollars. But this could be the case, right? It just depends on the history of the common stock accounts in any business. I could see a scenario. Someone says, oh, my parents gave me a $1,000 loan when I was 20 years old, and I used that to open a business, and I've grown my business into a multi-million-dollar company, and I've used no liabilities, I've taken no investment. So, okay, that's pretty much saying that, that person's common stock account has just stayed dormant over the years. Nothing's happened to it as the business has grown. Okay, so now at this point, the girl probably personally, she has a nice house, nice cars, etc. Over the past 20 years, the business has made more than $100 million in net income. And the reason is because some of that net income over the years must have been taken out to pay the owners. That's why this section is called retained earnings and not just net income, because it's accounting for, you made all this money and how much also did you take out? It's what have you retained? What earnings have you retained in the business and put into your assets? So maybe, the business has been doing well, and the the net income over the years built up has been 120 million, and 20 million has been taken out as dividends to pay the owners, right? But note though that any time the girl decided to take money out and pay herself, she is legally obligated. She would have been legally obligated to pay you 25% of whatever she takes out, right? She can't just funnel money out of the business and not tell you, because this is your business too. You're entitled to these retained earnings. Okay, and finally, let's change up the story a little bit and say that over the past 20 years, the girl has actually taken out some loans and mortgages and notes on some of her buildings and land. So maybe she's got some notes on equipment, maybe $4 million in notes, and maybe she's also got some mortgages on some of her buildings and land worth $6 million. Okay, so at this point, at this date, 20 years later, she also has $10 million in liabilities. But this is the only thing we're going to change about the story. So today the business is still the net worth of the business is still 100 million. The common stock accounts remain the same over the years. So for this to be the case, that would mean that if the business's net worth is 100 million, then the total value of the assets has to be 110 million, because net worth 100 million is saying that 100 million dollars of those assets the owners own. So if the business also owes liabilities 10 million, then there must be $10 million worth of assets around the business that creditors stake claim to. But that doesn't mean that, oh, well, if they owe creditors 10 million, then the retained earnings, they must have made $10 million more in net income over the years. Well, no, because any net income, that's the owners claim that. Nothing, the common stock and retained earnings, even, let's say, okay, so we went from our first story to this story. First story had no liabilities. This story, we have liabilities. Common stock and retained earnings is exactly the same. They have made $120 million in net income, paid themselves $20 million, so that, the common stock hasn't changed. So meaning that the owners stake claim to $100 million worth of stuff, but they also took out some loans to bring in $10 million more worth of assets. So if you drive by any business right now, you add up all of the value of all of the assets that business has, and then you take a look at the common stock accounts, so what people own what percent of the business, and then you look at the liabilities. So you would say for this business in this situation, creditors stake claim to 10% of all of these assets, and then what remains after 10%, Casey owns 75% of that, and you own 25% of what remains. And you might be tempted to say, well, that's not really the case. These creditors just stake claim to the specific note that they're tied to. So you took out a mortgage from the bank, from one bank, let's say, for all of this land. The bank stakes claim to just this land, not the buildings and the ingredients and the cash. It's just really it's the bank and it's the mortgage associated with this land. But no, that's not really the case, because you're going to be getting money in from revenues and from customers and taking those revenues and paying off the bank. You might accept some, external investment, $1 million investment from someone, and use that to pay off the bank. The bank, you just owe these people. They don't care how you pay them. If you would go out of business and sell off all of your assets, you're going to take some of that money, no matter where it came from, and pay off your liabilities. So whenever you're thinking about the accounting equation for any business, so the accounting equation is just a description of any business's financial position as of some moment in time, you're saying the total value of all of that business's assets, okay, that total value is equal to all of the debt that business has in general, and what remains the owners own, and you can divide up where that ownership came from into what has been contributed to date through common stock and how much net income the business has made less the dividends. Okay, but before I end the video, let's update the equation, get it correct. So if we're saying that the girl started the business and 20 years later you take a look at her accounting equation and the net worth is 100 million, with 10 million in liabilities. So net worth of 100 million means the owners have 100 million dollars in assets that they own, but there's also 10 million in liabilities in here. So the total asset value must equal 110 million. So you have 10 million in liabilities. We'll say that retaining that dividends, they have taken out $20 million over the years. That would mean that the $100 million in net worth, it's not fully in retained earnings because some of that $375 is still distributed amongst these assets. So technically you would subtract out 375 from 120 million, which if I took out my calculator, you would get, it would be very, very close to 120 million. Get 119,999,625 $. So this would balance down to the dollar, these numbers here.